Good evening. It is August 18th, 2021, 9:58 p.m. on the East Coast. And I want to start by talking about this MarketWatch article about these Netflix engineers charged with insider trading by the SEC. I think it's worth Googling this and reading the brief article and maybe even the indictment by the SEC. So these guys were able to access key metrics on the Netflix subscriber count, the growth of the subscribers for Netflix. And that's a key metric that drives the stock when the company reports earnings. So, and they were able to trade 13 separate earnings announcements. This group, led by one of the engineers at Netflix, leaking the key data, was able to make over $3 million in trading on Netflix earnings. And the SEC was able to catch them not by a tip or anything, but by essentially an algorithm that's able to, detect an unusually high rate of success trading the same stock and having pattern in the trading. I mean, 13 different quarterly earnings, reports, and they're guessing right every time. Put two and two together, and then if you look at the account and you see, well, they're basically only trading Netflix, and they're mostly trading on the earnings reports, and they're getting it right, an unusually high percentage. And then start to put two and two together and see that one of the guys knows somebody who works at Netflix or has a family member that works for Netflix. I think we're going to see more and more of these sorts of indictments come down. There is a lot of insider trading still going on in the stock market, especially around earnings reports of companies. So I just thought that was interesting, pointing that out. S&P just took a dump. So it was up to 43.99, just dropped a little bit. I want to point out this structure of the E-mini S&P. So we spent over a week, almost 2 weeks, between 44.20 and 44.76. And then tested 44.30, 44.20 a couple times earlier this week. And then this afternoon we cracked it, dropped all the way down to 43.81. Futures trading 43.93 right now. This is a precarious situation. This support zone, let's say 43.70 to 43.80, really needs to hold. And if we break through it, easily at least another 100 points of downside in the short term. And this starts looking more and more, when you look at the market breadth, and just the sector weakness across the board, this starts looking like it could be a potential major top. And I'm just saying potential. It's not the first time we've had a situation like this where things looked really ugly and the S&P had just dropped 2% or so from its highs. So let's not go too far, get too bearish, but there is plenty of cause for concern here. I mean, if you look at some of these drops that we've seen in some major market leading stocks and the number of sectors that have been down big this week, like the energy sector, Caterpillar is down 5 days in a row. There's a lot of charts that look like this. Down sloping 50-day moving averages, upward sloping 200-day moving averages. And price is just sort of in the middle, about to test the 200-day. The XLE is about to test the 200-day. The IWM is about to test the 200-day. Caterpillar is about to test the 200-day. So this is a big moment that's approaching the market. I mean, especially if it happens this week or early next week with, Jackson Hole at the end of next week. And then we have a long sort of holiday for Labor Day, basically like the 25th through early September is going to be basically just like a big holiday week for the market until the U.S. gets back from Labor Day. So, yeah, this is really interesting what's happening, what's lining up here in the short term over the next several days. A lot of things seem to be lining up for the market. So this is something to keep a close eye on. It feels like a big move or something important is coming. Doesn't necessarily have to be a downside resolution. It could be a bear trap, yet another bear trap. I want to point out the Russell 2000, the IWM. So this is like, the last 6 months. This is what the market has essentially done in 2021. Now, the S&P, we talk about the S&P a lot. We talk about the biggest 10, 20 stocks in the market all the time. But look at the Russell 2000, because this is much more representative of the actual stock market. Most stocks in the market. This is a massive range-bound mess. And there's really no other way to describe this. This is a big freaking mess. Basically, stocks trading in a big wide range between, let's say, 210 and 234 on the upside. So call it a 10% range for the IWM. And we're down here testing the bottom end of the range. And so this looks like and again, the rising 200-day moving average, this looks like a really important test is at hand here. And, we're down 5 days in a row in the Russell. There's a lot of stocks and sectors that are down the last 5 or 6 days in a row. Seems like a big test is lining up. It could be tomorrow morning. It could be Friday. It could even be early next week. But, it's pretty ugly out there. It really is. I want to point out the coin chart. Coinbase, we went long earlier here. Basically, what I'm seeing is a pretty important layer of support between 240 and 250. Obviously, I wish I had waited to buy this at the close instead of buying at 250. I could have bought it at 244. But, such is life. This is coming down to the 50-day moving average. 240 is a big support level. This has also dropped, 4 of the last 5 days, basically down almost 20% from last week's highs on pretty light volume. It's kind of dropped, just lack of buying. I think this is an attractive setup. I can have a very clean, stop loss. I mean, if this closes under the 50-day, I'm probably out of it. It's pretty clear. I don't want to see this drop into the 230s. I'm kind of expecting it to bounce tomorrow, or trade doesn't work. It's pretty simple. I have no problem dumping it and taking a small loss. There's a lot of charts, sector charts, like the energy sector, where this looks like a well-constructed topping pattern, but it has not broken down. It's not a completed top. For the XLE, 46 is a big level. Now, if there was to be, let's say a weekly close, certainly a monthly close under 46, this would look like a completed multi-month long-term top. I mean, like a 5-month topping process above 46. There is an open gap down here from February around 44. So again, sort of the point of this video is we're approaching a really critical moment in the market. This is a very interesting next few days, in my estimation. By the way, Pfizer, look at this candlestick and this huge volume, this outside reversal in Pfizer today. This looks like a pretty bearish daily candlestick. Volume climax, price climax after this tremendous run it's had in the last couple of months. It's extremely overbought. Let's see if we get confirmation. Let's see what the weekly candlestick turns out, looking like for Pfizer. Turning to the gold miners. So the GDXJ went long. The GDXJ earlier. I am totally insane. Clearly, I hate money. Clearly, I have no idea what I'm doing. Obviously, look at this chart. Who in their right mind would buy into this downtrend at 52-week lows? Yeah, I mean, this is the lowest level, the lowest closing level in more than a year for the GDXJ. And here I am, crazy Goldfinger, stepping in here and buying. Now, I outlined the reasons why I took this buy, this trade setup earlier in the trading lab. And basically, what I've learned in 2021 is that when charts are looking good and people are calling it a technical breakout, especially at multi-month highs or 52-week highs, that's generally been a great time to be a seller, even to short, like here. And just the opposite, when we're breaking down, things look terrible, like here, even last month here, we got a tradable rally. We got a pretty good bounce. And so I'm not looking for this to go back to $60, on this trade, but I am, thinking that there could easily be a 10% or even more than 10% rally with sentiment so poor in the gold mining sector. The charts are really oversold. Most gold miners have dropped like 20% in the month of August. I mean, some are down 30%. It's brutal. It's absolutely brutal. And, and then look at the long term. So, the longer term chart, the weekly chart of the GDXJ, 41 is a big level. 41 is a big technical level. And even this like 39 to 41 zone is a big area of potential support. This is a weekly chart. The week is not closed yet. So even though we're under 41 marginally right now, if this reverses higher, let's say it closes the week above 42, the support has held, and so there's the potential for some bottoming tails on these candlesticks, on the weekly candlesticks, against the backdrop of extremely bearish sentiment, extremely and outflows into the sector. So people are not positioned long gold miners. Portfolio managers have been getting out of gold miners for the last few months. Basically, that's their playbook. Their cyclical playbook is, well, okay, the economy's improving, the Fed's going to tighten, so we get out of the gold sector. And then turning to the fundamental reason why I went long today, it's interesting because I formulated this fundamental thesis, you could call it, after the Fed minutes came out. And it's interesting that Scott Minerd, the chief investment officer for Guggenheim Partners, published this around 6 p.m. this evening. And we're thinking along the same lines. And basically, he's making the case that the Fed is going to have to err on the side of caution, take a more cautious approach to the timing and speed of tapering plans. because of growing evidence that the economy is weakening, and with the Delta variant resurgence, and the lockdowns in certain parts of the world, travel is slowing down. Put it all together, the Fed is not going to want to tighten into the teeth of a slowdown. They've invested so much, they've committed so much to supporting the economy and the recovery over the last 18 months. Do you really think that they're going to risk it all and risk hurting markets, hurting the economy and growth by tightening too soon? The consumer sentiment, retail sales numbers. I mean, there's multiple data points that have come out in the last few weeks that were all appreciably weaker than consensus estimates. I don't think it's wise for the Fed to get tapering too soon. Certainly no rate hikes. I mean, I think we're still looking at 2023 before the possibility of any rate hike. And I still contend that the Fed funds rate will not ever be back above 1%. I think that 1% is the new ceiling on the Fed funds rate. So if you basically, assume that inflation is going to be 2% or higher, basically for the foreseeable future, we're going to have negative real rates as far as the eye can see. I mean, the Fed is not going to move real rates into positive territory. The global economy, the amount of debt, the massive debt bubble out there cannot handle positive real rates. So the long-term case for gold is very much intact. We have what could be a triple bottom, a complete washout in the futures trading a couple of Sunday nights ago. Gold has bounced impressively, even though sentiment remains poor. We're getting up into a pretty big psychological level. This 1800 level is no joke, and it also represents a confluence of the downward sloping 50 and 200-day moving averages. So I'm not expecting gold to go right back to 1900 anytime soon, but it would be very healthy if it were to consolidate north of 1750 and then have the potential to push higher, like do the unexpected and break out above 1835, that level that it fell from a few weeks ago. I don't think anybody Sunday night when gold was trading under 1700 expected $100+ rally over the next 10 days, and that's what we've gotten. Gold is trading much better than gold miners. Gold miners are telling us that gold is going to break this triple bottom. So we will see who is right. If we do push above 1800 in the next couple of weeks, I think it could trigger a tremendous short squeeze. Nobody is really positioned for a gold rally at this point. Victoria Gold. So this is very interesting because this stock has been one of the best gold stocks of 2021. Certainly in June, it was the best or in the top 5 performers in the entire gold sector, with basically almost a double for the year. Since then, it has fallen along with the sector, down about 30%. It's fallen pretty sharply in August, down more than 20% for the month of August. But notice it's right back to the 200-day moving average. Look to the left. This is key support. This is a big area of support here around 1450. And this is basically right back to where Victoria was when Core Mining announced that it had acquired nearly 20% stake in the company. with the potential to acquire more, with the potential to potentially make a bid for the entire company. So we're right back to these early May levels as if the core thing never happened. So I think expectations are very modest again, actually pretty low. I think a lot of people have sold thinking that Core can no longer buy, this company or is no longer, interested, whatever it is. But expectations are pretty damn low, and I'm not even counting on a buyout. So I've been buying VGCX in the last few days, from 1550 down to 1451 here this morning. So I've been buying it all the way down. I've got a pretty healthy position at this point, and I'm buying it because number one, the company is producing 200,000 ounces of gold this year at an average all-in cost of $1,100 an ounce. You can do the math. It's a lot of free cash flow, a very attractive valuation on any kind of cash flow or net income multiple, solid balance sheet. They've been paying down debt, and the potential is for the mine life at Eagle to be more than 20 years. I think they've just scratched the surface in terms of the potential at Eagle. Massive exploration upside here, and they're committed to increasing the production rate to 250,000 ounces. So 250,000 ounces per year is the goal for VGCX. I think they will achieve that in the next few years. And when you're talking about a 250,000 ounce mine, with a 20 plus year mine life in a good jurisdiction with relatively, inline costs, let's not call it low cost. I think low cost, these days it's under 1,000 per ounce all in, but 1,100 is certainly not high cost, very profitable. And so on a fundamental valuation basis, it's very attractive. Basically 750 million market cap in, US dollars, and technically extremely oversold and at support. Trade setups don't get much better than this one. That doesn't mean that it's definitely going to work, but I like my odds. Have a great evening, and I'll see you in the trading lab.